Welcome. You're listening to The Best of Investing. I'm your host, Edward Brown, along with my co-hosts, Mark Hunt and Nam Fon of Pacific Private Money. Our phone number is 888-912-1190. Use that number to answer the trivia question for a 5-pack tanning certificate given away during the show. And that certificate is not sponsored by the radio station, but by Tan Bella Tanning Salon, with 2 locations in San Francisco and 1 in Marin. And today's trivia theme is music from 1979. Nam, were you even born then?
Yeah, come on.
Just a wee bit.
All 2 years old.
2 years, yeah, that's right. Nam, you have apparently got some very interesting articles to share with us.
Well, I've got some too. I'm going to start out. He's got one that I'm actually excited about talking about a little bit later, again, relating to real estate. So listeners of this show in the past know that, we pretty much talk about real estate mostly, and mortgage loans and mortgage debt investments here on The Best of Investing, because we feel that real estate and mortgage-based investment strategies are really the best investment strategies in today's low-interest marketplace. And if you believe that maybe the stock market is probably about as high as it's likely to go, or at least over the next 12 months, is it likely to go significantly higher than it is today? Given that we're kind of back up to historic levels again, and there's a lot of funky things that can happen in the news in the coming weeks and months. We could certainly have an election. Well, we have an election coming, and regardless of which way that election goes, it could cause some instability in the markets. But when it comes to real estate, I have this great quote here from Mark Fleming, chief economist at First American. Said the only major industry to display immunity to the economic impacts of the coronavirus is the housing market. And that's really true. We've talked about that over the last multiple Best of Investing episodes about how resilient and how strong the residential real estate market has been, and how resourceful and strong the residential mortgage industry has been. If you're a borrower, that's been really good news for you this past year. Rates have continued to go down. If you're in the mortgage industry, if you're a mortgage professional, you're busier than you've ever been. If you're a real estate professional selling real estate, you're busier than you've ever been. I have here a number of articles, trying not to parrot the same things we've been saying over the last couple of weeks, but a lot of statistics have come out for the third quarter, and one of these articles are projecting where are home values headed over the next 12 months, because really we know that home prices have gone up this year, which was a surprise by many. But where are they headed for the next year, and what are the experts projecting at this time? And in fact, the experts projecting today, it's different from what they were projecting at the beginning of the year. In fact, this article says as shelter-in-place orders were implemented earlier this year, many questioned what the shutdown would mean for the real estate market. Specifically, there was a concern about home values. After years of rising home prices, would 2020 be the year when appreciation would come to a screeching halt, or even worse, would home values begin to depreciate? And we, of course, know that a lot of people were predicting home price depreciation. I had investors saying home prices were going to drop 30%. They were saying that in March.
I mean, and I understand that from the standpoint that, with the shelter in place, hey, you're not supposed to leave your home, so how are you supposed to buy a house? But also a lot of people, losing their job, you just assume there would be more sellers than buyers.
Yeah, in fact, original forecasts back in March ranged anywhere from a high of maybe 3% price appreciation in 2020. That was Zelman & Associates. They're a noted real estate expert firm. To home values depreciating by more than 6%, which was what CoreLogic predicted, which really surprised me. I was surprised by how bearish they were. As the year unfolded, it became clear that there would be little negative impact on the housing market. And so what's actually happened in the months of May and through July, that quarter, May through July, national home prices increased by over 2%, which represents the largest 2-month increase observed since the start of the index in 1991. So the largest 2-month increase in 30 years. So that's pretty surprising. And so what are the experts forecasting for home prices going forward? Zelman, who predicted 3%, is now predicting 6% over the next 12 months, starting September 1st, the next 12 months. And CoreLogic, who had predicted home prices go down, they're now predicting, well, 0.6. So basically, they're kind of hedging. They're safely saying it may go up only by a little bit. So they're basically saying flat year-over-year price appreciation. And Zelman is up to 6%. So again, very, very interesting. And we've got some more information, some more charts I can share with you about just how healthy and a little bit scary the home price market is right now.
Well, all right, guys, we're going to cut to our first commercial break. The theme is music from 1979. Here's our first trivia question. Message in a Bottle was performed by what band? All right.
All right.
Call 888-912-1190. First caller with correct answers. Going to win that tanning certificate. And oh, by the way, SeaTrek is still open for rental trips, classes, and even though COVID policies are in place, spend the day or evening kayaking with them on the protected waters of San Francisco Bay. Lightweight paddles, double kayaks, lots of fun. Go check them out. Reservations, though, are required. So go to seatrek.com to start your adventure. Stay with us. The Best of Investing. We'll be right back. Welcome back to the Best of Investing. I'm Edward Brown, along with Mark Hanf and Nam Phan of Pacific Private Money. Our first trivia question was the theme from 1979 music. Message in a Bottle was performed by what band?
The Police.
That's
right?
Very good.
The Police.
The Police. That's right.
By the way, this is kind of a weird off-color political question, but do you think that if Trump makes it back in, that all the Democratic governors are still going to keep COVID in place for another 4 years? You know, shelter in place, to try to show, hey, the bad economy and all that. That's just food for thought. Okay, Nam.
Probably not.
Probably not.
Yeah.
Nam, moving on to you.
Yeah. So just kind of to add to what Mark was saying in the previous segment. Actually, before I even jump into this article, what's interesting is usually these like CoreLogic making these predictions, they often take a few years to play out to see if they're actually true or not. But so many predictions that were made at the beginning of this COVID back in March, I mean, it's been such a compressed period of time where you've seen the results of whether or not those predictions are true.
Yeah.
Usually these things will be like 2 years from now, will people look back and say, this is actually what happened. But within 6 months, we're seeing, you know, really, really fast change. And this article from Axios, author is Dion Rabouin. I'm not sure how to pronounce his name.
You can say that.
Why the real estate boom could keep going for years. So this.
Wait a minute. Why the real estate boom could keep going on for years?
For years.
For years.
Wow.
Not months, not weeks, but years.
Okay, let's hear it.
So Dion starts by saying, even after reaching an all-time high average prices and sales numbers not seen since the height of the 2000s boom, the housing market still has lots of room to run, experts say. So he says, what's happening? There were fears in late 2019 and early this year that price levels had outpaced income growth and become unsustainable, but record low mortgage rates and promises by the Fed to keep U.S. interest rates at zero through at least 2023 have lit a new fire under the market.
Well,
so
plus,
2023.
Yeah, and also, isn't the economy kind of getting a little bit better? The unemployment's going down?
Yeah.
I feel that.
Yeah, and home prices rose 4.8% nationally in July, according to the latest Case-Shiller.
Is that year over year,
index.
or does it say?
No, it doesn't say.
Okay, I think that's a year-over-year figure. There's a bunch of different year-over-year figures depending on what metric you're looking at, but that sounds about right, roughly 5%.
Yeah, he also adds existing home prices hit a record high average of $310,000, up 11.4% year over year.
Yeah, that's the median.
Yeah,
Okay.
and the overall home price was a record $319,000 in August, 13% gain over 2019. So the big picture, it's not just low rates. There are a few big factors that could buoy the housing market for years to come. Here's a few of them. Older millennials, a historically large generation, are reaching their late 30s. An important marker as there have been a persistent 20 percentage point gap between the percentage of homeowners under 35 and those 35 to 44.
Mm-hmm.
And I think it was in our last show, one of the stats we had mentioned was the number of millennials or people aged 24 to 29 who are still living with their parents, or maybe who moved back in with their parents. It was 50% of that population.
Because
so
you're talking about because of COVID.
Yeah, because of COVID or maybe other circumstances. But that group living with their parents, they're being able to keep a lot of their income because they're not paying rent. Well, unless their parents are charging rent, but they're accumulating wealth, probably enough to put a down payment on. And this is going to, when COVID
that's a good point
back,
because, you know, at some point, the kids are going to say to mom and dad, I got to get out of here. Or the mom and dad are going to say, it's been fun, but get out, you know?
Or both, right?
Yeah, exactly.
Yeah, get out. Well, I was planning to get out anyway. But so all of these stats come, and the last one, home builders have been slow to erect new housing since the global financial crisis, limiting supply, which we talk about, and one of the reasons why we have the North Star Capital Fund. So all of these events coming together. And actually one last one is right now the market's hot because there are fewer listings on the market. So sellers are holding back on selling until the COVID kind of, recedes.
Yeah, because they got to figure out where they're going to go also.
Yeah.
And how, with these latest fires, seems to be at least once a year this is happening, how many homes have been lost so far to date? Do we know?
Fortunately, not as many as 3 years ago when 5,000 homes burnt down.
Yeah.
I think it's still under 100, but they had the numbers broken out between Napa and Sonoma, and I think it was approximately a dozen in Sonoma County, and Napa County it was higher, like between 50 and 60, and that was as of Wednesday. So it may be higher because they only had less than 5% containment as of the news cycle this morning. So yeah, and the winds shifted, fortunately, in the direction of fewer homes today, so that was good. So, but the point being is that it seems every year now, for the last 3 years, we've had catastrophic fires in California. We wonder if it's going to be an annual event now going forward, and will there be homes lost? And take, for example, the 5,000 homes lost in Santa Rosa alone in 2017. Less than half of those homes have been rebuilt. I mean, it's incredible how incompetent the government is at fast-tracking building permits. Number one. Number two, the banks who all said, oh, we're going to help rebuild Santa Rosa. I've tried to get bank financing for clients, and it's ever since COVID hit, forget about it. They're not making loans right now. So private capital is the only thing available out there to help builders rebuild these homes. So it's just there are so many impediments, systemic impediments in place in California to prevent people from building, whether you're replacing a fire destroyed home, or God help you, trying to do an infill development project of one or more units. I have a client that's trying to do an infill project in Roseville right now, and it's 10 acres, completely surrounded by subdivisions that were built 20 years ago, and you wouldn't believe how incredibly difficult it is to get entitlements through. It's just expensive, it's slow, and constant challenges. You would think that there were too many homes on the market right now, and it's exactly the opposite. So there is, no matter what Governor Newsom has said about his, years ago he said, or a couple of years ago he said that it was his goal to, 3 million new home units or something was his target. Nothing's changed. The cities and counties are still run by bureaucrats. And we talk about bureaucracy rage around here. You want to talk about road rage? We regularly here at our offices suffer from bureaucracy rage because there is just massive systemic incompetence in government.
Well, they got to keep their job.
Makes it impossible to get a permit to build a home.
I think that's part of it. They have to keep their job, right? If they got nothing to do, then they're going to get fired. So you got to go really slowly with this stuff. Hey guys, getting to the second commercial break. 1979 music is our theme. Who was the artist that sang, or who was the artist who sang Cars? Do you remember the song Cars? All right. I'm purposely not singing it because it'll give it away. Call 888-912-1190. First caller with the correct answer is going to win that tanning certificate. And don't touch that dial. The Best of Investing. I'll be right back. Welcome back to the Best of Investing. One more time, I'm Edward Brown, your host, along with Mark Honf and Nam Phan of Pacific Private Money. Our second trivia question with the theme of music from 1979. Who was the artist that sang Cars?
I don't know that, but Mark will sing it, right?
No, we were singing it off the air, unfortunately.
Gary Newman.
Oh, Gary Newman, that's right. Yeah, he had some funny songs.
Okay.
I wouldn't have guessed him.
It's a one-hit wonder, I think. Okay.
Yeah.
Let's see. Mark.
I have some more on real estate before we move on to, just want to kind of round out our discussion of real estate news hot off the press. Quote here from Chief Economist for Redfin says the recent boost in the number of people listing their homes for sale this fall still falls far short of demand from people looking to buy homes right now. Well, we knew that. We actually mentioned that in the last segment. Unfortunately, he says this means little relief for home buyers, especially those seeking an affordable home. He doesn't expect double-digit home prices to subside before early 2021. Now, did he say double-digit home prices? Because I thought that one report was just there was like a 5% year-over-year increase. Well, it depends on, as you know, there's a lot of different metrics that are used to measure home price appreciation. One of them is the median home price index, and I've got a whole bunch of charts here which our radio audience can't see, but home sale prices are up 14% year-over-year through September, as measured by the 4-week rolling average of the median home sale price. Now, this is a nationwide figure. We already know in California home prices are up, but nationwide, they're up year-over-year. The 4-week rolling median average, for what that's worth, is up 14%. Pending sales year-over-year, up 30%. So pending home sales unit volume is up over 30%, is up nearly 30% from last year. Listings, new listings of homes is up 6%. However, active listings, so they say new listings, meaning, you know, recently added, is up 6%, but the actual unit number of total active listings nationwide is actually down 30% over the last 2 years because we just don't have that much inventory on there. So depending on how you look at the metrics, you have to be careful about it. So we actually have fewer homes on the market, which is causing home price appreciation. That's basically supply and demand. We talked about this statistic recently, which I was shocked by. The sales price to list price ratio is at 99.4%, meaning that most people are getting the price they're asking for, which is, that is hugely up over prior years. They don't say what that is. I have to look at this bar chart. I guess last year and the year before, 2019, 2018, it was closer to 98%. So again, national average, it's almost 100%. So pretty interesting. Oh, last statistic, homes are also getting into contract faster. So they say almost 50% of pending sales are under contract within 2 weeks. So stuff's flying off the shelf. In fact, we just lost a $4 million bridge loan that we were pretty excited about to get for a transaction here in the Bay Area. The borrower got pre-qualified with us for a $4 million bridge loan that he was proposing to close in 2 weeks. Well, he got beat out by an all-cash buyer who promised a 4-day close.
4-day close.
4 days. Wow,
that's
like amazing.
Make an offer on a Thursday, close on a Monday.
Yeah.
Just,
and I wouldn't recommend to anybody to close unless they somehow did their due diligence prior, but that doesn't give you a whole lot of time to really take a hard look at the property and make sure there aren't any unexpected conditions with the property. But
especially when you're talking about a big loan like that. Hey, let's move on, guys.
That's got to be really frustrating. Oh, I was just gonna say it's got to be a really frustrating time for buyers because these rates like the 15-year fixed rate mortgage just fell to 2.49%. So this cheap money to be able to buy a home, but there's no homes to buy.
And it's also even that low if you apply for a refinance today. Depending on where you go, a lot of banks and mortgage brokers are basically, they're overwhelmed right now, and a lot of them aren't taking new applications. So it's an interesting time that we're living in right now. Cheap money, but there's a lot of demand to refinance right now into ever decreasing 30-year rates. There's very little inventory out there, so the demand is pretty high. I think people who are thinking of selling but haven't sold yet, and who might be reticent to put their home on the market now because we're getting close to the holidays, although who knows what Thanksgiving and Christmas is really going to look like for most of us. But I wouldn't be surprised if there was a robust and vibrant resale market starting in January once people get through the annual holiday period. So pretty interesting stuff in store for us.
Hey, tell you what, guys, let's move on to, we have an email here. It says, please explain how your Freedom Fund can be so liquid. So you give a little bit of backstory for that. We have a couple of minutes.
Yeah, so we have 4 funds at Pacific Private Money, and the Freedom Fund is one of our newest, and it was recommended to us by our law firm when we were pursuing a way to basically raise capital to use like a warehouse line of credit. So the Freedom Fund is set up like any other fund. It's a 506 Reg D-C for those of you who have invested in funds before. It's a private placement. And the only difference between that and other funds is that our use of the money is to close on loans that we have a buyer for. So we close loans with the capital and then we sell it. And even though the fund documents, the operating agreement, the subscription agreement, the private placement memorandum does have your typical required under Rule 144. For those of you who are familiar with that, with SEC regulations, it does have a lockup period in the documents. However, we're silent in the documents as to any penalty for early withdrawal. So even though we've set it up now, we've got $10 million in that fund, and no one has yet to request their money back out. Should someone need their money, because it's a liquid fund and we're selling those loans within 30 days and revolving that capital back into cash on a once to twice a month basis, it's a liquid fund. So should any of our investors in that fund request their money, we have agreed to accommodate them within 30 days, even though, and there's no penalty for early withdrawal. So essentially, for an investor, it behaves like a money market account, even though it's technically not. For us, it behaves like a warehouse credit line. And it's actually cheaper for us than a warehouse credit line because it's just, we have so many people we know that want to take advantage of earning 7% on their funds. And so it's a real win-win for both sides. So it's a highly liquid fund. We pay a flat 7%. There's no fancy accounting. It's just we pay you for the use of your money, and you can take it out whenever you want without any load or penalty. So for more information.
Yeah, more information, and then we got to cut.
Okay, PacificPrivateMoney.com, PacificPrivateMoney.com.
All right, stay with us. The Best of Investing. We'll be right back. Welcome back to the Best of Investing. Edward Brown here, along with Mark Hanf and Nam Phan. Next time we get to the break, we'll do a new trivia question. But Nam, you got a deal of the week?
Yeah, deal of the week this week comes to us. It's a deal in Sacramento, and this is not a bridge loan. So sometimes we talk about bridge loans every week because we do so many of them, and it's such a popular product right now. But this is one where just, there's still investment opportunities out there in the marketplace. And a borrower came to us to acquire funds or to get a loan on a duplex that he found in Sacramento, and he lives here in the immediate Bay Area. This one comes to us because he had to act. He needed to close quickly, and also his funds were a gift from his mom, so that he could she could help him get this duplex. Loan's only for $324,000 against a property value in Sacramento of 540. So 60% loan to value. He needed to close quickly. He'll be in this loan until his gift funds can be seasoned, which is a requirement for being able to get a conventional loan. In this case, it's going to be a non-QM loan that he's going to qualify for next. But there's still opportunities out there for investor borrowers in the marketplace. And in this case, younger gentleman and very smart, making an investment in real estate duplex that he'll be able to hold on to for a long time. He's going to rent out both the units, and it's a great way to build wealth. So, for those people, opportunistic investors out there, I mean, there are deals. And if you're somebody who wants to invest in real estate, there's a lot of different places where you can go to learn about these, but oftentimes the best deals are ones where you really have to work hard. Some people knock on doors to find opportunities for a homeowner who may just want to sell, and you just happen to come across and reach them at the right time.
I used to do that.
Yeah, but once you find that person, then it's like, geez, I need to come up with the funds. So outside of our bridge loans and some of the construction ones we do, there's always room to do private money for like fix and flip, or people who are buying and holding.
Yeah.
So just
I literally just before we went on the air, I had a tax guy give me a call for a loan potential where the guy could pay all cash, but he's also at the same time doing an offer in compromise with the IRS, and he's about to sell another piece of property. And the problem is, if he pays all cash, he's got very little leverage with the IRS, because they'll say, well, wait a minute, you bought this new property for $600,000 all cash, and so we're going to attach the whole thing. So he wants to put down as little as possible, so that they won't have that much equity in there. There's a new one for you, And
offer and compromise, and he's sitting on a bunch of cash. Well, there's a novel idea.
Yeah, exactly. Well, he's about to sell this other property, so it's,
okay, got it.
Trying to do all the planning and all that. So,
we've been talking about price increases in real estate and the health of the residential real estate market, and I made a note because Nam, in the article you were talking about, that basically asked the question or made the statement why the real estate boom could keep going on for years. There's been a discussion, and I made a note to myself, price levels unsustainable. There's been a lot of discussion over the last many years about home prices have gotten to a point where they're unsustainable from an affordability. The affordability index is pretty low right now, and yet the Fed has said, look, we're not going to increase rates for the next couple of years. I've read articles that are of the opinion that we may not see in our lifetimes, which I have to hedge that again since we're on the older side of the scale, but we may not see in our lifetimes 6 to 8% mortgage rates, which used to be quite common 30 years ago, right? Or 20 years ago. I mean, the weighted average over the last 30 years of the mortgage rate is 6.5%. So, and here where you have mortgage rates in the high 2s, low 3s, so the argument is that just wait until mortgage rates go up again. That's when you're going to see likely see devaluation, home price depreciation. It's just what's really hard right now is to predict going forward what combination of economic events would have to exist for the price of money to go back up again, or is this a structural phenomena that we're seeing now that the Fed is going to continue to keep the price of money as low as it is? Factors like inflation. What if inflation heats up again? What could cause inflation? So it's a really interesting discussion, because there aren't any real easy answers, nor is it easy to predict right now. And we've been wondering when home price appreciation was going to stall or even retrench, like it did back in 2007, 8, and 9. But we just don't have the conditions like we did back then to trigger what was then, or in hindsight, called the real estate price bubble. We just don't have, people are using that term bubble today, but there aren't any underlying factors other than cheap money that have been driving prices up. So demand is high, inventory is low, money is cheap, and the banks want to lend it. So those are all, and then, well, last but not least, employment levels. Even with unemployment levels that reached where they did during the pandemic, if that didn't cause home prices to reduce, and looking forward over the next 12, 24 months, you would expect unemployment to only go down once again and possibly have continued recovery in the economy. I don't know. I don't ever claim to have a crystal clear crystal ball, but I'm not seeing, nor are the economists that I respect and follow, I'm just not seeing the combination of events short of yet another unexpected black swan event that could cause the residential real estate market to crater. And why that's important for us at Pacific Private Money is because we make investments. We offer investments to our clients based on mortgages. We call it mortgage investing. We have mortgage pool funds. We have individual trust deeds, and those are paying anywhere from 7 to as high as 10%. And again, for more information, and we're running out of time, we're going to go to our fourth commercial break here. But for more information, you want to call us at Pacific Private Money, 415-883-2150, 415-883-2150. Go to our website, pacificprivatemoney.com. We have 5 ways to invest, including our 4 mortgage pool funds, backed by, well, 4 of them are backed by California real estate, 1 by Texas real estate, but again, all real estate backed, and you owe it to yourself to investigate.
All right. Guys, go to our last trivia question here, 1979 music. Peaking at number 4 on the Billboard Hot 100, Don't Bring Me Down was a chart popper for which group? All right, stay with us. The Best of Investing is going to be right back.
I know that.
Welcome back to the Best of Investing. Last time for today, I'm Edward Brown, your host, along with Mark Hoff and Nam Phan, who are singing in the background.
We're trying to guess the trivia question.
Because of this trivia question, because the way I said it here. Peaking at number 4 on the Billboard Hot 100, Don't Bring Me Down was a chart topper for which group?
ELO, right?
ELO, very good.
Yeah,
Don't Bring
actually
Me
knew
Down.
one.
Yeah, very
I took music
good.
studies class in college.
And I tried to say it very, no accent or anything, no inflection, make it harder. But no, that was very good. You guys did well. So before we do our thoughts for the day, talk about your funds for a little bit. So your Freedom Fund is fairly liquid. It pays 7%. Your regular Pacific Private Money Fund is paying right around 7.5% with a 1-year hold. No fee to get in or out of either of those. Your North Star Fund is paying 8% plus, and the newest Texas Fund is paying 9% plus. And again, no fees to get in and out or any of those. They all have a 1-year hold except for your Freedom Fund. That's pretty amazing.
Well, yeah, and people have asked, why do you have 4 funds? You had 1 fund for 7 years, now you got 4. All of the additional 3 launched during COVID, I might add. What's wrong with you guys? What's going on? These other funds have been in the works, some of them for well over a year. So it was just coincidental that COVID hit and we decided to continue going forward because, again, stock market was doing weird things at the beginning of COVID. People were looking for ways to invest their capital. We thought it'd be a good time to launch these funds that were already in process. So the reason for 4 funds is that these other 3 funds we created, in addition to our hard money legacy fund that we call the Pacific Private Money Fund, that you alluded to, 7% preferred return, paying about 7.5 to 7 3/4, consistent returns for the past 7 years. We launched these other 3 funds because they have different models. They have different models for the loans that they invest in and make, and so hence there are different yield opportunities, and they have different preferred returns. So again, our legacy fund, the Pacific Private Money Fund, the 7% preferred return, paying in the high 7s. The North Star Capital Fund is a construction loan fund. It's designed to help builders and developers find capital to do ground-up construction, which is an underserved lending product right now. 8% preferred return on that. Our target yields on that are 10 to 12%. Again, we launched that in July. The Pacific Southwest Note Fund invests in Texas mortgages, specifically seller carryback loans that we could buy at a steep discount. Preferred return on that fund's 9%, and our target yields are 12% and higher. In fact, we'll be doing our first accounting for August and September. Our first distributions are going to be in the next couple of weeks, and so we're all curious to see where that lands. And then last but not least, our Freedom Fund, like we talked about earlier in the show, pays a flat 7%, and it's for people who don't want to tie their money up for long periods of time, but they're sitting on $250,000 or more and would like to earn money on it. Where else can you take any amount of capital right now that you want to keep liquid and get 7% on it? Nowhere that I'm aware of. So it's an absolutely unique product in California, very popular. We've raised $10 million in 90 days. We'll probably cap it at about 20 million, so there's still room there. That's the only fund we have that has a $250,000 minimum. The other funds are 50,000 or 100,000 to get in. There's offering memorandums available on all 4 funds. We also have flyers, 1-page flyers with a summary page. It's a 5-page deck altogether. We're happy to send it to you. Please reach out to us. You can call or email from our website. Go to pacificprivatemoney.com. Email us. We'll send you that deck. And happy to meet with you or talk to you and explain to you how our funds work.
Very good, guys. We're going to cut out. Here's our thoughts for the day. Obstacles are things a person sees when he takes his eyes off his goals. And life before a computer, I don't know if I'll get through all these. I'll get as far as I can. A memory was something you lost with age. An application was for employment. A program was a TV show. A cursor used profanity. A keyboard was a piano. A web was a spider's home. A virus was the flu. A CD was a bank account. A hard drive was a long trip on a road. And a mouse pad was where a mouse lived. And with that, tune in next week to The Best of Investing. We're going to be giving away more free prizes for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long.